Hi, this is Mijin from Beer Ceylon University. Let's begin today's Beer Ceylon news for November 24th. Welcome to Mion, where we continue to uphold the fundamentals of investing in United States stocks as always. My John Bem viewers, I hope you all had an enjoyable and productive weekend. My family did a really fun activity over the weekend. I've mentioned this before on the show. We applied for something called the Malaysia My 2H visa. The Malaysia My 2H visa is a special visa called Malaysia My Second Home. So you don't necessarily need to have a job, and if you meet the requirements, they give you a 5-year visa. But there is one condition. You need to have a certain amount of deposit. This is an amount you can get back later. And you need to own a property in Malaysia. That means I have to buy a house. So lately I've been thinking a lot about where I should buy one. Buying a house is a major decision and an interesting experience. Yesterday I went to see a really big apartment, and compared to Korea, apartments in Malaysia are really huge. Here they call them condos. I took my kids with me and we saw a really nice condo. It's located right in front of the school so the kids can walk to and from school. The location is really good. It's a bit more expensive than my budget, but I'm not sure how things will turn out. I'm planning to make an offer that's a bit lower than the asking price. Later, when we move to another house and have our own place, I'll call and show off our new house in Malaysia on the show, kind of like a housewarming and a little bragging. All right, let's get started with today's Big 2 news prepared for November 24th. It's the first broadcast of the week. Let's start by reading the messages left by our valued subscribers and members. Today, I'll be responding to 2 comments. The first comment is a valuable one left by Bayonon Saramhes. I'm a beginner investor who usually keeps up with Jihun Mi. Maybe because I've been experiencing losses lately, I'm feeling anxious about investing. When should I enter the market? I'm just looking at stock-related information every single day. Anyway, soon. Yeah, there's a very simple answer. This is something I've mentioned a lot on my broadcasts. For investors, letting go of greed is most important. The word greed carries a lot of meaning. Our desire to sell at the highest point and buy at the lowest point is also an impossible greed. So right now, Credo is announcing its earnings, but after the announcement, no one knows whether the stock price will go up or down. So I think worrying about this is just another form of greed. In times like this, what you should do is use a strategy where it's good whether the price goes up or down. So, if the amount you plan to invest in Credo Technology is 2 million won, then you can invest 1 million won out of the 2 million won right now. It's already dropped a lot, hasn't it? And if it drops again after the earnings announcement, then that's another opportunity to buy at a lower price, right? So you can buy the remaining 50% at that time. And if the earnings announcement is so good that the stock price soars. But since we've already invested 50%, you probably won't feel too disappointed. So I'd like to advise you to try using an investment strategy where either outcome works in your favor like this. Now today I'll read one more comment. This time it's a comment left by someone using the identification Chloe Lee. Hello, Miju. Thank you so much for always sharing insights into the United States stock market with your great videos and in-depth analysis. I'm a Miju membership subscriber and a working mom of 2 kids, learning investment principles by consistently watching your videos. As you emphasized, Miju, I deeply agree with your advice that to withstand a market correction and seize opportunities, it's important to keep about 20% of your assets in cash. I've realized once again the importance of having a good portion of cash. However, I'm curious about the strategy for when the remaining 80%, excluding the 20% cash, is tied up in stocks and the market enters a prolonged and significant downturn beyond just a correction. I'm actually a bit afraid, wondering if the lost decade from long ago might come again. I'd like to ask if Mijunim would hold on and maintain the 80% stock position even during a downturn, or if you have a clear exit strategy, such as selling a portion to protect against losses. I think this is a very important question for viewers like my family, who have a high proportion of investments in the United States. It would be very helpful if we could hear Mijunim's thoughts on this matter. I know you're busy, but I'd appreciate an answer. I think this is a very important question. And as for the answer to this question, it's a bit too complicated for me to just answer off the cuff. I think it would be better if I take some time to think about it and organize my thoughts. I created this exclusively for Mijun. I'll read aloud the piece I wrote myself so that you can all follow along with me. What main question did you mention here? The key question is, if a real bear market comes, not just a correction that recovers in 4 months, but a true downturn that could last more than 2 years, how should we respond? And how can we detect the signals? In other words, how can we recognize when a bear market has arrived? That's what this question is about. So today, I'll discuss signals that indicate a major bear market, not just a correction, and strategies to address it. I'd like to share my personal thoughts and principles with you. Now, first of all, this is the most important question. How can we spot bear market warning signs? You mentioned the lost decade, and the lost decade was the dot-com bubble. So in the 2000s, the stock market didn't rise for almost 10 years and ended up moving sideways. And also in 2007 and 2008, when the subprime mortgage crisis broke out, there was a huge market crash. The most recent example is in 2022, when we also experienced a terrible bear market. Now, is there a way for us to detect the arrival of such unwanted bear markets in advance? Let me share my personal thoughts on this with you. Now, first of all, a correction, which is called a correction in English, refers to a drop of about 10% to nearly 20%. We had this happen once in April. But this correction, it comes around frequently depending on changes in market sentiment. This means that even if the United States economy avoids recession, inflation stays stable, and interest rates don't rise, corrections can still occur. In short, corrections are unavoidable. They just come at unexpected times when we least expect them. So since they can happen anytime due to changes in market sentiment, you just have to accept it. And it's okay to accept it. In just 4 months, it recovers its previous high. That's just on average. But what we call a bear market is different. First of all, the drop is more than 20%, and it often lasts for 1 or 2 years. Sometimes it even lasts for more than 3 years. But a bear market always comes with clear economic cracks, and that's very important. So to some extent, we can sense it. So what I do is, I mainly try to catch these signals through economic indicators and the market's valuation. Now, let's talk about the most recent bear market in 2022. It started on January 1st, 2022. At this point, we need to look back. Back then, inflation and interest rates were everything. At that time, the market was intoxicated by the liquidity party. As you may remember, governments around the world released a huge amount of money because of the pandemic, so a massive wave of inflation was coming. And as soon as prices soared, the Fed announced tightening. There are 2 types of tightening. One is absorbing liquidity, and the second is raising interest rates, which we already knew about. The start of a high interest rate era, especially harmful to the stock market and growth stocks, was the strongest sell signal. That's how it goes. Especially there were so many overvalued stocks without solid earnings, and those were the ones most likely to collapse first. That's how you should see it. So, right before the market started to collapse in early January 2022, I've summarized the specific signals as follows. First, the surge in inflation was the first signal. The Consumer Price Index, or Consumer Price Index, had already surpassed 7%, and later it went over 9%. What news was circulating in the market? Reports said inflation hit its highest rate in 40 years, the biggest rise in 4 decades, and this was the first time since then those stories appeared. And as inflation rose, companies started to feel pressure on their profit margins. This shows companies' net profits are falling. Secondly, as inflation surged, the Fed's policy eventually began to shift. So there was a clear indication that interest rate hikes would happen in the future. For reference, the first rate hike was March 16, 2022. That's why about 100 days earlier, on January 1, 2022 was the peak. About 100 days before the rate hike was the peak, and it's been trending down since then. You can see that the decline is continuing, and that's not all. Secondly, there was also a clear signal that the Fed would end quantitative easing and actually start quantitative tightening. And for your reference, the first quantitative tightening was decided at the Federal Open Market Committee meeting in May 2022. So to sum up, the Fed already gave a signal about 3 to 5 months in advance, and that was the peak. After that, when interest rates are actually raised or quantitative tightening begins, you can consider that it's already too late. You can see this because stock prices have already dropped for 3 to 6 months by then. Even if you leave now, it's not too late. Third, there were signs that the short and long-term interest rate gap was narrowing and inverting. That's what I'm talking about. The 10-year bond is long-term, the 2-year bond is short-term, but their yields are inverted. That's how to view it. When this happens, there's often a high chance of recession. Stress in the financial markets increases, and liquidity starts to decrease. So you should view the inversion of short and long-term government bond yields as a negative sign. And even if we're not investing, there are some parts we need to pay close attention to. This means the growth stock valuation bubble is starting to burst. Even in the mid-on topic, there are a few stocks that can be called growth stocks, but most of them are blue chip stocks. But usually, when a bear market comes, growth stocks are the first to plummet. At that time, a representative example was ARKK, the fund managed by Cathie Wood, and high-growth tech stocks drop first. When that happens, we need to be a bit more cautious. That's one of the warning signs that other stocks could also fall together. You can think of it that way. The reason is, it's a sign that the market's risk appetite is decreasing. So, the riskiest assets fall first, and then the less risky ones can also continue to fall. In this way, we can infer the stages of a bear market. So the beginning of 2022 was the peak of the stock market, and then a very tough bear market came. But at that time, there were clear signals. First, inflation surged. Second, interest rate hikes were almost certain. Third, the yield curve inverted and liquidity shrank. This was just before quantitative tightening began. Lastly, growth stocks fell sharply, marking a rare occurrence of all 4 signals happening simultaneously. Historically, when these signals appear together, the likelihood of a bear market is very high. That's how you should view it. So for those of you watching this broadcast, it would be good to check how similar the current situation is to 2022. Next, we're going a bit further. It's the year 2000 and 2008. Those of you who invested in 2000 and 2008 probably still remember how terrible things were. Let's go over it once more. First, the dot-com bubble burst in 2000. At that time, the price-to-earnings ratios, or PR, of internet companies were so high that they couldn't even be explained. Most stocks had PRs in the hundreds. Also, the surge in stock prices for unprofitable companies signaled an impending crash. The atmosphere was very different then. Back then, there were pairs of hundreds or even thousands of times, and it was very common for the stock prices of companies with deficits to go up dozens of times. So just from that alone, we could already sense, now the stock prices are going to crash. We could pick up on those signals. Next is 2008. At that time, the yield curve inversion, which is considered the most accurate leading indicator of a recession, also occurred. And this was a strong warning signal that there was a problem in the financial system. In addition, there were many other warning signs of a bear market. For example, companies with no earnings kept going public via IPOs. With so much liquidity, everyone felt pressured to go public quickly. Second, we entered a cycle where short-term government bond yields kept rising. Third, expectations for corporate earnings were revised downward. What this means is that stock prices have gone up, but expectations for earnings performance keep dropping. This is another part we need to watch closely. Next is subprime, as things like delinquency rates surge. Overall, you can tell that the current loan market isn't in good shape right now. Also, credit crunches happen between banks and housing prices decline. Now, when several of these signals overlap, that's when we need to start worrying that a financial crisis or economic recession might be happening. Therefore, in 2000, 2008, and 2022, these common signals were detected. It can be summarized neatly like this. First, market liquidity shrinks. As I said earlier, stock prices only rise when there's enough money. So, if there's 5 million won in the market and 5 companies, then each company gets 1 million won. But if it's not 5 million won and it goes up to 10 million won, the investment limit per company rises to 2 million won, allowing stock prices to potentially double. Liquidity is really important like this, and if liquidity decreases, it can be a decisive factor for stock prices to fall. That's how you should see it. And rising interest rates are related to reduced liquidity. When interest rates go up, liquidity inevitably decreases, and the tech stocks we love will inevitably see their valuations drop. So rising interest rates are a very tough signal. If it looks like we're entering a cycle of rising interest rates, you need to consider reducing your stock holdings. That's how you should see it. In addition, if there are signs of worsening earnings or declining margins, it's the same situation. If stock prices are rising but a company's earnings are actually falling, that's a very bad sign. And it becomes a burden in terms of valuation. This is also connected. When earnings get worse, what we call the PER is basically comparing price and earnings. If earnings fall, of course the valuation goes up. So if earnings don't rise but only the valuation does, the PER will surge. In this situation, you can see a sharp market drop may be coming soon. Lastly, when the credit market becomes unstable and we see signs of a recession, that's definitely a bear market signal we need to be very cautious about. Next time, I'll share strategies for handling these situations. I believe that it's impossible to predict the market 100%. That's why, as you know, I don't try to predict the direction. You can see it as me taking probabilistically favorable positions while checking if signals appear repeatedly. As I usually tell you, if I see the whole as 100, I usually hold about 80 in stocks and about 20 in cash. The reason for this kind of allocation is, of course, that I feel much more comfortable psychologically when I have about 20% in cash. That's the first reason. The second reason is that, according to historical statistics, the probability of the United States stock market rising is over 70%, almost 80%. Therefore, allocating 80% of my assets to stocks and 20% to cash basically matches the probability of the stock market going up. So, since it's a game of probability, it's very important to take a probabilistic approach. That's how you should see it. But if a definite bear market signal that appeared in past bear markets shows up, for example, inflation suddenly surges, interest rates are likely to rise, we see historically high valuations, and even signs of an economic downturn appear. When these kinds of signals are detected, the probability of a bear market increases. In those situations, I plan to adopt a strategy of increasing the cash portion from the current 20% up to a maximum of 50%. Then you might ask, why not 100% instead of 50%? If the probability of a bear market increases, shouldn't we liquidate everything and hold 100% in cash? You might wonder about this. But stock investing is a game of probabilities. So, as I mentioned earlier, it's impossible to predict the future of the United States stock market with 100% accuracy. So if I was convinced it was a bear market and sold my strategy, if the market suddenly surges in the opposite direction, I could lose my composure and make an even bigger mistake. And one more thing, no one can predict the lowest point of the stock market. The biggest surges in the market usually happen when stock prices are falling. As prices keep dropping, they suddenly skyrocket. That's how the biggest rises in the market occur. Because these surges are concentrated in a very short period of time, if you miss this period, your long-term returns can be severely damaged. So, to prepare for when my predictions are wrong. It's much safer and statistically more likely to succeed to leave 50% of your assets or half still in the market. That's how you should see it. It's 50-50, right? So you're basically betting with a 50% chance it'll go up and a 50% chance it'll go down. This is risk management, and it's also about maintaining a humble attitude in front of the market. This is how I keep my greed in check, and that's how I'd like to present it. The 50% cash I've secured like this can become ammunition to buy quality assets at bargain prices if a market crash actually happens. When everyone runs away in fear, we have peace of mind because we have 50% in cash. So you can see it as a resource that allows you to buy stocks at low prices. This investment strategy manages risk without missing opportunities. I'll conclude by saying that this can lead to long-term success and financial freedom. Let's quickly review the current state of the United States stock market before continuing. I've updated the S&P 500 map to display data from the past week. Last week, the market was clearly declining and the artificial intelligence, beneficiary and tech stocks we favor performed poorly. You can see a lot of bright red, right? Alright, so over the past week, most of the indexes recorded negatives, and especially the Nasdaq 100 at the top was the worst with -3%. Tech stocks mainly drove the decline. Now the good news is that last Friday, the United States stock market tried to rebound as it showed an upward trend. As you can see, the market breadth went up to 39 on Thursday. It had dropped to 31. And the stocks with good long-term trends also rebounded from 47% to 53%. So whether this rebound will become a signal that consistently favors the upward direction or whether it will drop again, we need to closely monitor the stock market today and tomorrow. That's how you should see it. The volatility index is the same. At one point, the VIX index surged past 26 to 28, but now it has eased and dropped to 23. If I zoom in a bit, this is the picture. The VIX, which went up to around 28, has started to fall again. So, we need to watch a bit more to see if this upward trend is calming down or if it will break through the previous high and go over 30. Next is the Fear and Greed Index. The Fear and Greed Index has also risen to 11. Originally, it had dropped to 6. Of course, there's still a dramatic sense of fear right now, but the atmosphere is starting to rebound a little. There are some signs, and we interpreted it positively. And lastly, it's the same when you look at the stock price chart. In the last broadcast, I mentioned that the third buying opportunity has come. It was 6,547. As you can see, it's starting to rebound again from that point. So once at the 20-day, once at the 50-day, and now for the third time, we've reached a resistance line where we can expect a rebound. I think that's how I can explain it. Our top picks in non-supported competitions performed poorly last week. Only 2 stocks ended up in the positive, and Google performed the best. With a gain of 8.41%, Google stood out on its own, and the second was Talon Energy, which showed a 1.40% increase. The third was Broadcom, down 0.66%, but still holding up well. Tesla fell 1.25%, Meta 2.50%, Tesla 3.28%, TSMC 3.43%, Nvidia 5.94%, Credo 8.27%, Celestica 9.91%, and Palantir 11.01%. Bitcoin plunged 11.39% in just a week, and Ethereum dropped 12.59%. The good news is that cryptocurrencies are currently showing a sharp upward trend. Bitcoin has already risen to 87,800 and Ethereum is recovering to 2,856. Now, hold on a second. We need to check again today and tomorrow to see if this is just a technical rebound, what we usually call a dead cat bounce, or if the trend is finally finding support at the bottom and starting to rise. Coinbase is down 15.35, and while Micron Technology rose almost 3% on Friday, it's still down 15.99%. AMD is down 17.4, B2 is down 20.04, Bitmain is down 24.4, and finally, the Ultra Ether Exchange Traded Fund showed the worst trend, dropping 24.9%. Now here is today's main article. Earlier, we checked the weekly performance of the United States stock topics together. Quick-witted people have probably already figured it out. United States stock topics decreased by 1, so it's back to United States stock 17. One stock has been dropped starting today, and today I'd like to talk about that stock. It's MicroStrategy, the company we call Strategy. Now, I'll explain in detail today why I suddenly removed this company from the United States stock topics. Earlier, we saw a bit of a recovery in the United States stock market, including the S&P 500. So there's growing anticipation that maybe this is the bottom and we're finally starting to rebound. Now, there's one prerequisite for the stock market to rebound. Cryptocurrencies need to go up first. Cryptocurrencies are the most representative risk assets. So for risk assets to rise, the riskiest ones go up first. That's how you should see it. So if you think about it, now isn't the time to give up on your strategy, because there's a high possibility that cryptocurrencies will rebound before the stock market does. Now, nevertheless, I'll explain through this article why I decided to remove the strategy from the recommended topics at this point. First, if we look at just the key part of the article, it says that the cost of raising funds has surged. So what this means is that as Bitcoin dropped, the price of preferred stocks also plummeted together. The price of the preferred stock, which was 85 cents per dollar, dropped to 66 cents, causing the yield to soar from the original 10% to around 15%. Therefore, securing funds to purchase Bitcoin in the future has become an urgent issue. So what this means is that you need funds to buy more Bitcoin in the first place. To raise these funds, they issued a lot of preferred stocks. But when they issued the preferred stocks, the yield was originally 10%. MicroStrategy's strategy was to raise funds by offering a 10% yield, then invest that money in Bitcoin. Since Bitcoin can go up more than 10%, they said, we will use this leverage to generate a lot of profit for you. This is the current strategy's investment approach. The problem is that 10% has increased to 15%. That's how you should view it. Now, for cash dividends, issuing new securities is essential, but the drop in preferred stock prices is making it even harder to secure funds for dividends. If they don't pay dividends, investor sentiment will get worse. If that happens, even issuing more preferred stocks won't attract buyers. So when preferred stock popularity drops, in the end, the yield could rise even further from 15%. That's how you should see it. Now, this alone is already a huge negative factor, but one more major negative event has overlapped. It says there's a possibility of being excluded from Morgan Stanley Capital International, right? Morgan Stanley Capital International. They're considering excluding companies with more than 50% of their total assets in digital assets from the indices they manage. Now, if that happens, there's a very high chance that strategy will be excluded. So John Pierpont, Morgan, analyzed this situation. If it's excluded from the Morgan Stanley Capital International Index, about $2.8 billion could flow out from various ETFs. And if other indices join in, there's a high possibility that up to $8.8 billion in passive funds could be withdrawn. This analysis is being released. So if that happens, even though the stock price has already dropped a lot, there's a high possibility that Strategy's stock price could plummet even further. Now, I'd like to sum this up with a word from me, John. So if we comprehensively consider these two key risk factors that have recently been raised, I personally believe that investment in Strategy has entered a phase where a structural reassessment is necessary. Let's discuss preference first. The biggest burden is that the sharp drop in prices has caused funding costs to rise dramatically. This year, Strategy has issued preferred shares and convertible bonds to boost its Bitcoin purchases. They use this money to keep buying Bitcoin. Now, this kind of leverage-based strategy has the advantage of providing high returns if Bitcoin continues to rise online. That's because of the leverage effect. Now, however, I mentioned that recently the price of preferred stocks has dropped significantly compared to the issue price. As a result, the required rate of return in the market has risen to about 15%. Because I invested, but the price actually dropped below what I paid, right? So since I need to be compensated for that loss, the demand is to pay more interest. Therefore, the economic feasibility of raising additional funds in the future has significantly worsened. From now on, you need to pay up to 15% interest to raise funds for buying Bitcoin. That's the way to view it. So to put it another way, this means it's now more likely that fundraising costs will outpace Bitcoin's rate of increase. For example, if Bitcoin goes up by 15% in the future, you still don't make any profit, so it's much better to just invest in Bitcoin itself. Now you can see this as a structural problem that could shake the core business model of strategy itself. On top of that, there's an increasing risk of being excluded from the Morgan Stanley Capital International Index, which means the investment risk has become much greater. What is Morgan Stanley Capital International? They're considering excluding companies with a high proportion of digital asset holdings, specifically those with more than 50% from the index. At the moment, there's a very high possibility that strategy will be subject to inclusion. So, if the exclusion from the index actually happens, there could be forced selling by passive funds like ETFs and mutual funds. Because ETFs and mutual funds track the index, right? So, if strategy is removed from the index, they have no choice but to sell strategy as well. If that happens, it could trigger billions in capital outflows and cause major instability. Now, the reason why the combination of these two risk factors is especially important is because of this. It's because even if the price of Bitcoin rebounds in the future, the stock price of strategy may not fully reflect that rebound. So even if Bitcoin rises again, the selling pressure from passive funds and the increase in funding costs could act to limit the recovery of the stock price. That's how you should see it. So that's why, in fact, recently in the market, there have already been concerns raised about the possibility of a decoupling between the price of Bitcoin and the stock price of strategy. This means that even if Bitcoin recovers, strategy's stock price may not rise. That's the warning being given. And in the worst case scenario, strategy might have to sell its Bitcoin holdings due to a failure in raising funds. We can't completely rule out such significant risks either. So in conclusion, until these two risks are resolved, it seems more reasonable to avoid investing in strategy. And there's one more thing we need to remember. Recently, it's not just strategy whose stock price has dropped. The spot price of Bitcoin has also fallen, and as a result, B2, the wrapping average exchange-traded fund that tracks Bitcoin, also plummeted in price. That's not all. Along with the price of Ethereum, the stock price of Bitcoin has also plummeted. So what about the investment funds that are bet on strategy? Right now, there's still a chance for cryptocurrencies to surge when they rebound, and it's a clearer choice to move to something like B2, which has less investment risk compared to strategy or to Bitcoin. That's what I think. Now, B2, which is an unsupported top pick, or if the spot price drops, the spot price has dropped. Utading, 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 utading. Rather than a strategy with too much risk, it's safer to move your funds to something like B2 or Bitumen, which can absorb this trend if altcoins surge later. That's the conclusion you can draw. For B2, there's no risk of index exclusion. And depending on price fluctuations, the leverage effect is reflected just like in a strategy-based investment. And also, in the case of Bitumen, there are no preferred shares issued at all, and the debt ratio is very low, so the funding risk is relatively very small. Moreover, in the case of Bitumen, it doesn't just depend on the price of Ethereum. With staking and an infrastructure-based revenue model, it gains extra cash flow beyond simply holding Ethereum. Therefore, assuming that the cryptocurrency market will rebound in the future, for investors who want to secure more stability and upside beta, moving funds from strategy to B2 or Bitumen is considered a much more reasonable and valid choice. I'll wrap it up here. Of course, this is just my personal opinion and my own trading plan. I want to stress again that this is not a buy or sell recommendation. The last prepared content for today is a video about United States stocks, and the main character of the dubbed video prepared today is none other than Michael Saylor. This person is the Chief Executive Officer of MicroStrategy, whom I just talked about earlier. So this Chief Executive Officer explains the strategy for additional Bitcoin purchases. What's even more important is to hear about the reasons behind the sharp decline in cryptocurrencies and the outlook for the future as well. That's all for today's Big Stock News on November 24th. Thank you for staying with us until the end of the first broadcast of the new week. Now, November is racing toward its end. I hope you continue your healthy and happy journey of investing in United States stocks with MeG1 this week as well. Let's keep working together until we retire with United States stock investments. Have a great day. Thank you.
Thank you. Currently, there is selling pressure in the cryptocurrency market, and Bitcoin has fallen below $90,000. Because the volatility is very high, anything can happen by the end of the year. But what do you think is the main factor driving the current Bitcoin selling pressure?
Do you think there have been 15 serious crashes over the past 15 years, and I think it's about time for a correction to appear now? This is a natural deleveraging process of assets, and it's a phenomenon that occurs every 6 months to a year. There have been 5 major corrections like this since 2020.
We have experienced them. You announced a significant purchase this week, and although you've been buying Bitcoin for several weeks, it wasn't on this large of a scale before. Could you tell us what strategy you base your decision on when determining the timing for additional Bitcoin purchases?
Our business is engaged in issuing digital credit, meaning we create credit backed by Bitcoin, and at that point, Bitcoin is used to sell the credit. Last week, we sold a government bond-based credit product called Stretch, worth about $130 million. And we also issued a European credit product called Esterim, which was worth about $700 million. The credit products we issued pay dividends and can offer a 10% dividend based on face value. Over time, Bitcoin becomes the foundation. When credit investors buy these credit products, we use the capital secured from those sales to purchase Bitcoin. Therefore, our Bitcoin purchases are essentially driven by the credit market.
Determined. No matter how you sleep, the beginning of a dream is important. Nurture your ambition and grow little by little every day. Enjoy today's journey. Even when darkness falls, I'm not afraid.